Crucial interest rate jumps to highest level of Trump's second term. That's the headline from the New York Times, reporting that the yield on the 10-year Treasury bond has climbed to 4.7%, its highest point since President Trump returned to office in January 2025. The yield was at 4.6% on Inauguration Day and had been below 4% before the Iran war began in late February. This rise matters because the 10-year Treasury yield serves as a benchmark for borrowing costs across the economy, from corporate bonds to home mortgages. As yields climb, the administration's promise to keep costs low for businesses and households becomes harder to fulfill. The housing market is already feeling the impact. According to Freddie Mac, the average 30-year fixed-rate mortgage now stands at 6.58%, up from below 6% just before the first U.S.-Israeli strikes on Iran. Nancy Vanden Houten, lead U.S. economist at Oxford Economics, warns that this latest increase in rates will push home sales down unless it's quickly reversed, and it comes at a time when families are also facing higher energy and food prices because of the war. Analysts point to several forces driving yields higher. Soaring oil prices have raised inflation expectations, but there's also a surge in growth expectations tied to the massive build-out of artificial intelligence infrastructure. If that growth isn't tempered by higher rates, the economy could overheat and spark more inflation. At the same time, investors are worried about unsustainable government spending around the world. Jonathan Hill, an inflation strategist at Barclays, says the Iran war isn't helping, but it's not clear that the 10-year yield is being driven primarily by inflation risk. The trend isn't limited to the United States. In Britain, 10-year gilt yields have jumped 0.9 percentage points to over 5% since the war started, reflecting concerns about the fiscal plans of new Prime Minister Andy Burnham. In Japan, 30-year government bond yields have risen 0.7 percentage points to 2.8% as the government rolls out heavy spending plans. Similar worries about high public spending persist in the U.S. as well. All of this puts the Federal Reserve in a delicate position as it watches long-term rates rise while the administration pushes for lower costs. For now, the 10-year Treasury yield remains a key gauge of whether those competing pressures will ease or intensify. Thanks for listening. I'm your host, and this has been your Economic Update.